Hey, loan officers, listen, you're trying to close more deals, and the only way to do that is to work with more real estate agents. You want to have a conversation with them, but you need an icebreaker. Listing Booster is the greatest icebreaker because it's going to bring you and them more business. The whole thing's been revamped. It's all new technology. And guess what? Once you have that relationship with the agent, Listing Booster is going to get you more transactions. Check it out. All you have to do for a demo is click this banner right over there. Now, according to the Wall Street Journal, the average car payment is $686, and those that are taking a car payment above $1,000 is at record highs. That's nuts to me. Well, why is this? Well, car prices are higher for sure, but the main reason is interest rates are going up.
Yes, interest rates. The use of someone else's money with rates set on the Fed fund rate. Now, it's not just the $1,000 car payments that are the problem. It's our insatiable appetite to consume. Get this. U.S. consumer credit surged in May to yet another record high. Consumers borrowed an additional $22.3 billion in May alone. Problem?
Yeah, it's a problem. It's because we know that when the Fed fund rate moves, it doesn't affect mortgage interest rates, but it does, my friends, affect mortgages. Think of it like this. The Fed rate affects your bottom ratio, that being your housing expense and your other debt obligations. So the Fed rate absolutely changes qualifying for your clients because all that debt and the high cost you're paying for it lands on your qualifying bottom ratio. Hence, you qualify for less. Think of those newly minted $1,000 car payments and that record $22.3 billion in revolving debt. Yeah, that's on your bottom line ratio.
Side note, car repossessions are exploding. That's the real estate industry's canary in the coal mine. Why do we say that? Because people let their bills go before their homes. So the next domino to fall after car payments are house payments. But back to the point of how.
And by the way, more foreclosures just means more inventory. It's not a bad thing. But back to the point of how. When the Fed lowers their balance sheet and slows to stop buying mortgage-backed securities, that does have a direct effect on rates, which affects your top ratio, your housing expense alone ratio. So it looks something like this.
Fed balance sheet top ratio, Fed fund rate bottom ratio.
Does that make sense to you? Because this is important because what the Fed is effectively doing is lowering their balance sheet and raising rates, meaning the current Fed policy is an all-out assault on home buying aspirations. It's making things way less affordable on all fronts. Now, here's what makes this thing totally crazy.
The Fed's moves are intended to slow or even reverse home prices, and they've never been this aggressive, which brings us to our third point.
Home values, they're still going up in spite of the Fed's actions. So the current unholy housing triumvirate that buyers face today is the Fed fund rate, the Fed balance sheet, and values. All of the three are working to make homes less affordable for buyers. Is it working well? Yeah, homes are less affordable for sure. The problem is the goal is not to make homes less affordable. The goal is to slow down inflation. Is that working? Decidedly not. So what we're getting is all the bad without any of the good. The Fed's diagnosis for what ails us is tantamount to a form of chemotherapy that doesn't cure cancer. Anyways, make it a great day. I can't wait to see you until tomorrow. Bye.